Hey everyone, it's Tom Savantry, Premier Trust Advisors. I'm really excited you're joining me today. What I'm going to cover is something that goes against the grain of what a lot of people are preaching, looking at life insurance as an asset and the returns associated with it. Most of the gurus out there say that life insurance is just a terrible investment. Never do that. Just buy term, invest the difference, and you'll be better off. Just throw it into the market and buy your term insurance, and hopefully you'll never ever use it, and you cover yourself just until your kids are older. That's the mantra. Well, what today I want to look at is what is a life insurance policy and what are the returns in them. We're going to look at a detail of an actual one today that I pulled for a 35-year-old. And when I step back from a life insurance policy, and it is an asset, but when they say that's a bad investment, it's a wrong comment, because life insurance, in my mind, is not an investment. Investments are earning that you have a chance to lose your principal, right? There's no guarantee you're going to earn a rate of return. And I'm hoping to get returns in the at minimum 8% to 12% range with my money. And so certainly that's a topic for another day, but when I look at a life insurance policy, I equate it to more of a savings account. It's where you can store your cash, because the money that's accumulated within these policies have no risk of going down, they're tax-free, and they're actually liquid. So you can use them all through the course of your life as it builds up. So let's go through this in a little more detail. So this illustration, just to orient you what we're looking at. So this is an illustration for someone who's 35. And we're going to look at this through someone who's going through the age of 65. And that's what we're going to look at. So on the right-hand side here, you'll have the premium, which is $25,000 each year, starting at age 35. And the net cash value that is building up throughout the course every year, and the death benefit that's also building up because you're buying some more insurance along the way through the way this policy is designed. So looking at over the course of this 31-year period, you'll see that the internal rate of return in this policy is 3.68%. Now, that doesn't seem overly sexy, for sure, certainly not from an investment perspective, but let me just kind of make sure you understand what this 3.68% means. And so what it really equates to is that we're putting in $25,000 plus into this account each and every year, this life insurance policy. It's going to earn the equivalent of 3.68% each and every year through the life of this illustration. And that will get us to 1.47 million down here. So I hope that makes sense, even though that's not how it actually accumulates in the policy, and I'll show you that as we go along here, but that's the equivalent to it, and that's what that 3.68 equates to. So as I mentioned, this is a cash equivalent. And so when we're thinking about cash equivalent, what do we think of? We're thinking of savings accounts, checking accounts, a CD, money market accounts. These are all sort of in that ballpark. And CDs, unfortunately, are not as liquid. Can't tap into them. But within these policies, you can tap and utilize the assets within these policies throughout the course of time of you owning them. So if we were to say, what's an equivalent rate of return you would earn on something like a product like that? So we'd say maybe 1% today, just for an example. And unfortunately, for these types of savings accounts, you would have to pay a tax on them. That doesn't happen in the life insurance policy. So when you factor in the case of the taxes, now you're looking at a 4.91% is what you'd have to earn in a alternative account, and then you factor in the taxes to get to what you would earn within this life insurance policy. So I'm not sure where you're going to find that in something that's equivalent, where it's safe, where the money, the principal cannot go down, and you have access to it, liquidity. to that money. So that's the criteria we use. So looking at this, it's a sizable difference. Now, let's factor in the case that if you didn't get the permanent life insurance policy and you wanted to cover and protect your family, you need to get term insurance. So now we're including term insurance. And so this is a term life insurance policy for $1 million here, $1,500 a year. But then when you look down here at age 65, it jumps to $105,000. Now, what do you think? Are you going to keep that policy or not? Well, you're likely going to cancel it. So we'll say let's cancel that at age 64. Now, then you'll lose the death benefit at that stage. So now you have to earn a rate of return of 5.37% each year in an alternative account to reach what you would get within a permanent life insurance policy. So I would suspect it would be very difficult to find a savings type vehicle that could earn that amount. So let's look at how these two compare. Now, if you think it from a cash perspective, if you go with the alternative account, you'll get to $832,000 versus the $1,471,000 within the permanent life insurance. So over a $600,000 difference in the cash value. Now the death benefit, also sizable difference. Remember, you canceled it at age 65 when it shot up to over $100,000 for the premium. So here you have $832 is your death benefit if you died that year, but versus $2.8 million in the permanent life insurance death benefit. So a significant difference in what would be passed on to your beneficiaries going this route. So not only do you get more cash, you have a higher death benefit to protect your beneficiaries. Pretty good deal. It's exciting. So now this is just safe money. Again, I just want to reiterate, this is safe money, but still earning to earn 5.37% is nothing to sneeze at in a policy that would, in this sort of situation, that cannot go down. The principal can't go down. Now, the one thing I did want to touch on was the cash comparisons, which is typically one of the things about life insurance people dislike, is that it builds up cash slowly. So that is true, and it's purely the design of the policy, because the first payment you make, if you die that year, your beneficiaries get the death benefit tax-free. So that's a significant risk to the life insurance company. So they build that up and only give you some of the cash up front as you start depositing your premiums in here. So by year 10, you'll see that the cash value within the policies finally start exceeding what you'd have in the savings account. Now, that may seem a long time, but if you go through this illustration another 20 years, you'll see that that spread starts getting much, much bigger. It's just the initial stage of these accounts are just not, they can be painful. And you have to be thinking about this long term, because then you'll see the massive benefits as you get into the later years of these policies. And this only illustrates the years to age 65. It gets even bigger as you get later down the road in your life, and I'm hoping that we all get to live a long and healthy life and see that number even expand farther. And the greatest part about the permanent life insurance cash value is it grows uninterrupted in this way, but it's accessible. Now you can use it as a piece of collateral to use, that you can to get a loan from the insurance company, or use an equity line to tap the collateral within those policies and use it for investments, to use it to loan out to others. And so that can increase what you're returning on that same money. So you can actually have two streams of money working for you instead of just one. Now, as I mentioned, hopefully it's very clear, this is a savings type vehicle, because there's no way this money can go down in value. It's not at risk, and it's liquid and accessible. So if you were to equate it to a investment account, most investment accounts typically would come with some sort of management fee. So if we say conservatively 1.5%, now you'll see that this alternative account would have to earn close to 7% year after year with no down years to get to the equivalent of what you get in a cash value life insurance policy in this illustration. So that's when we're comparing gross to net, and that's the fallacy that happens often. People are comparing what you can get in the market at a gross level to something a net, what you get net from a cash value life insurance policy. It's just not equivalent. So taking it from a net perspective, you see you have to earn a pretty sizable amount in an alternative account to get to what you would get as a benefit for a cash value, and you get the death benefit on top of it. So even though it may not equate to some of the larger investment returns that you are aiming to achieve, thinking of it from a perspective of a savings account, the life insurance policies provide a tremendous return as a savings vehicle, and it gives you access to earn even more by leveraging the cash within the policies.